Today, we will look at these areas. I'll take a very simple one first, that is superannuation. Superannuation in the sense, what we save for long term, continuously save. If you are an employee, you get salary. When you get salary, you will see certain deductions, compulsory deductions. They are almost like contractual savings happening on behalf of us. We all know it's better to save for rainy days, but most of the salaried employees do not save a very good percentage. Automatically, when you get your salary slip, you will see certain amount is deducted, and the reason is EPF, ETF. That kind of things are covered under superannuation. Superannuation is an organizational pension program created by a company for the benefit of its employees. It is also referred to as a company pension plan. Funds deposited in a superannuation account will grow, typically without any tax implications, until retirement or withdrawal. Okay. Now, when you enter into the job world, employment, at a very early stage, automatically, you will find a fund is growing on behalf of you without your involvement. That is good for you. At the same time, those who manage the fund will find they have enough money to do good results bearing activities. EPF is one of the biggest funds in South Asia. Okay, so superannuation is a pension fund where it will be beneficial for the employees who contribute when they reach the retirement age. The investment policy, okay, each and every month you get a very good amount to invest. Where are you going to invest? Now the fund should have fund managers. The investment policy of the major superannuation funds continue to focus on earning a long-term positive real rate of return for the members, while ensuring the safety of the investment and maintaining adequate liquidity for refund payments and other expenditure. Okay, from one end, you get a large number of employees who will monthly contribute, and the aggregated amount is substantial. They are not going to ask that amount in an emergency. For a savings account, when you maintain a savings account in a bank, the customer can withdraw at any moment, and we do not know when he is going to withdraw. Here, the fund is growing and the employee cannot withdraw until he reaches the maturity age, say 55, or until his death. If so, a very good amount is growing. Therefore, you can think on long-term projects. That's where the fund goes and invests. At the same time, this fund should be safe. If you invest in a project where the project fails within 5 years, then you will not be able to meet the requirement of the employees. At the same time, you must maintain adequate liquidity to refund the payments and other expenditure. If the contributing employee retires or dies, you have to pay him. For that, you must maintain a certain amount in cash or cash equivalent. That's what we call liquidity here. The superannuation fund sector consists of EPF, which is the largest systematically important superannuation fund in Sri Lanka, ETF, Public Services Provident Fund, and approved private provident funds. So there are only four types of superannuations in Sri Lanka: EPF, ETF, PSFS, and APPFS. The risk profile of superannuation funds, particularly of the two major funds, that is EPF and ETF, are similar, and their financial positions indicate their risks were managed adequately. The credit risk of the fund is negligible. Okay, why? Now let's discuss a little bit then the superannuations in Sri Lanka. Sovereign wealth funds. When nations got excess money, they wanted to save them in areas which are important to them. We have talked about Norwegian Petroleum Fund, and I have said by now they own more than 3% of entire equity shares of the world. Even in Sri Lanka, if you look at uh, the list of top 20 shareholders in Sri Lanka, you will find Norges Fund or Norwegian Petroleum Fund is in the list of Commercial Bank, JKH, People's Leasing, Central Finance, Access Engineering. Okay. You'll find that name. So the Norway government invests their excess money, sovereign wealth fund, even in listed companies of Colombo Stock Exchange. But even though they have enough money to acquire a company itself, they do not invest more than 5% of any single entity. Why? Can someone tell me why the Norwegian Petroleum Fund, even though they can buy the entire Access company or reach the second highest shareholder of Access, they are not doing that. Instead, they are happy to remain below 5% of ownership. Can someone tell me why? Yeah. Any purpose of diversing to that extent? Yeah. To mitigate the risk. Means what? Even if a company where they go and invest fails and collapse, but still they can bear it. Okay. So the purpose of Norwegian Petroleum Fund is to ensure one day when they lose the petroleum earnings, still they can provide adequate return to their population. Okay. Similarly, superannuation funds, when they have long-term investments, from one side, they have to think on risk. If you get very high risk for investment purpose, you may also get a very high return, and you will find one day your risky assets were gone, vanished into thin air. Therefore, EPF and ETF, they manage well, they manage adequately well, looking into risk factor. Why? 90% of the investments, both EPF and ETF, are held in government securities, which have zero default risk. The funds are exposed to interest rates risk as a result of high concentration of investment in fixed income securities. Okay, so they invest 90% in government securities, which are interest bearing instruments. Therefore, they are highly exposed to interest rate fluctuations. But the interest rate risk has been minimized by investing in a variety of securities with different yields and maturities. The fund's vulnerability to liquidity risk is minimal given the steady inflow of funds through members' short-term treasury securities. Okay. First, we look at EPF. Can someone tell me how much out of your salary is deducted for EPF? What is the employee contribution percentage and what is the employer contribution percentage? Can someone note the percentages? Out of your salary, how much is deducted for EPF? From your part, from the employer's percentage. Okay, right. Good. 8, 10, 12. Altogether 20%. 8 by the employee and 12% by the employer. That is the contribution by employee and employer towards EPF. EPF. Now, EPF was established under the EPF Act number 15 of 1958 to cover any employment, including any employment in the service of corporation whose capital or part of the capital is provided by the government. Under current legislation, any establishment, irrespective of the type of category of employment, becomes legally liable for payment of contributions to the EPF on recruitment of even a single employee. Right. Even if you employ just one employee, still you have to pay EPF. But household employees are excluded. The EPF is the largest superannuation fund available for private and semi-government employees. The EPF had 2.4 million contributing members in 2016, representing 20% of the working age population, that is 18 to 60. Total fund balances had increased from 1 billion in 1972 to 1.3 trillion, 1.8 trillion. The Commission of Labour is the charge of general administration of the Act, while financial responsibilities with the Monetary Board of Sri Lanka. Now, for exam purpose, you can be asked, right, who is administering EPF? So the answer is Commission of Labour. Right. Financial responsibility of EPF, that lies with CBSL. That's on EPF. All employees, either permanent, temporary, apprentices, casual, or shift workers, are considered to be covered, and enrollment in the EPF is mandatory. Even if you have only one employee, still you must get registered for EPF. Under the EPF, as mentioned above, employer and employee are required to make monthly contributions to the EPF. Okay, so we talked about the percentages. Employee 8%, employer 12%, altogether 20% out of your salary is saved. That's a very good saving. Earnings for the period include salaries and wages, cost of living allowances, cash value of meals provided, and food allowances. That is the aggregate. Employers are prohibited from compensating themselves for this contribution through reduced wages. In the event that happens, the commissioner can order the employer to pay the presumed differences in contributions. Employers are also not allowed to deduct the contribution amount from employees' earnings. The EPF mainly provides income security after retirement. Now, that is the main purpose. EPF, when you retire, you will get hold of a good lump sum. Members can withdraw their EPF account fund balance after reaching the age of 50 for females and 55 for males. So there is an age barrier. Means what? If you join for employment at the age of 20, at least 30 to 35 years, your earnings will be saved on behalf of you. From one side, the fund can get 30-year-long period to repay. Means what? You can engage in very long-term projects. The refund amount consists of all accumulated contributions and the accumulated interest. Yes. So not just the amount of money you have saved, but the amount of money you have accumulated as interest will be given to you. Members can also withdraw their account balance before reaching the specific age if they leave the workforce due to permanent disability, migration, join in a pensionable employment, or upon marriage of female employees. Okay. So these are the areas where you can withdraw money. Prematured. Members can nominate beneficiaries to the eligible to receive the funds if the member dies before reaching the prescribed age. The average value of the refund was nearly, so there's amount. Total contributions collected, that's the amount in billions. However, EPF falls short for providing private sector employees income security in their old age. This is because, number one, EPF provides a lump sum payment instead of a periodic income. Yes. So EPF is not giving you the retirement benefit of the government employee, where at the end of the month you get a steady income. Instead, EPF gives you a lump sum, one big lot to manage it yourself. There is inadequate replacement in income. Yes, it is not really income, but a lump sum, a capital where you can think and use wisely. That's up to the employee upon retirement. Since the EPF refund is a lump sum payment at retirement, it is the sole responsibility of the retired person to effectively manage that money to provide their own income security for life. Yes, some employees take this entire lump sum and maybe purchase a vehicle or hand over to a child, and very soon find he is lacking income to meet day-to-day requirements. Now that's one problem with the way EPF, but still, if you are wise enough, you will get a capital, a good amount of capital to restart your life at the age of 55. Purchasing an annuity is not a realistic option for most members, since the annuity market in Sri Lanka is limited. Even if the individual was able to invest their EPF funds as an annuity, it would inadequate income for most. Now, annuity means I'll put my money with the belief I get monthly income. Say I go for the fixed deposit, but I want monthly interest. Now that is, I'm developing annuity. But if I develop that annuity, my monthly income is not adequate. Then we talked about approved provident and pension funds. The EPF Act of 1958 allowed for the establishment of approved provident and pension funds or approved contributory pension schemes. Employers can contribute towards the APPF instead of EPF. In 1996, the legislation was introduced preventing the establishment of new APPF funds, although existing APPF funds were allowed to continue. Okay, so approved pension funds are no more in practice as a new fund, but if you have been practicing, yes, still you can continue. There are 177 approved pension funds in 2006 with 96 billion worth of assets, and it's on decrease because we are not giving new approval for new funds. So approved provident and pension funds is on decline. The numbers are on decline. EPF. So you said it very clearly. I left it blank. What is the percentage? What is the percentage? Now you know the percentage. 8% here and 12% here. Funds managed by Monetary Board. Administration by Commission of Labour. This part you have to remember for exam purpose. Who is managing the fund? Who is administrating the funds? Right. Percentages now you can complete. So out of your monthly earning, how much? Right. We talked about Norwegian Petroleum Fund. That is one of the best managed sovereign wealth funds in the world. Let's say a lot of oil, petroleum product exporting countries, they get a substantial excess fund and they decide to invest this excess money wisely. Now, Saudi Arabia, they prefer to invest their excess money in arable lands where you can cultivate lands where you have water and happily do agricultural activities. You have heard about a country called Ethiopia, where people are starving to death. But Ethiopia is an African country where you can grow paddy. There are paddy fields. There is a large area known as Gambella. That area was purchased by Saudi Arabia as an investment option. They have purchased a lot of lands in Indonesia, where you have water and arable lands, lands where you can cultivate and earn and get crops, a harvest. Why do they prefer to invest in lands, arable lands? That's what they lack. They have a desert and petrol. So a very good investor will diversify the risk. If you don't have oil, still you will be able to eat. You have access to arable lands. China, even though they are not into this oil exporting category, they are the biggest exporter in the world and they have enough excess money. Can someone just think and tell me where they mostly invest? Okay, if you think about Saudi Arabia, they invest what they lack. What they lack is land for agriculture, and they invest in that. China, when they have excess money, where would they prefer to invest? Can someone tell me a product where China would like to invest? Yeah, can someone tell me where China would prefer to invest? Yeah. Can someone tell me where China prefer to invest? A good alternative for investing? Right, so I see some good answers. Okay, right. China, they have safe state administration for foreign exchange. That's what they prefer to invest. Safe. Okay, so what are they lacking? They invest mainly in US dollars. Means what? US dollar is asset which you can purchase. So sovereign wealth fund, safe state administration of foreign exchange of China, they are looking into foreign exchanges. That's what they want to invest. Okay. So funds diversify. Why? To maintain liquidity, to reduce investment and concentration risk, enhance rate of risk. Okay. Now you can see China invest what they don't have, American dollars. Saudi Arabia invest in what they don't have. Okay. Norway, when they started to invest, they initially invested only in US government's treasury bills. Can someone tell me why? Only in treasury bills of developed nations, ideally US Treasury bills. Can someone tell me the reason why they selected only government securities of developed nations? What were they looking at? Stability, risk. They were purely considering on risk. So they have mitigated the risk. And after a few years, when they evaluate other wealth funds, they do fantastic returns. Qatar, a very small country, Qatar Sovereign Wealth Fund, they were investing in, yeah, can someone think and tell me where Qatar, another sovereign wealth fund, huge petrol fund, where can they be investing? Now, you know, they invest, but they don't have. Can someone think and tell me where would Qatar invest? Another investment option? So in order to diversify, you prefer to invest in what you don't have. Qatar is a very small country. Okay. So when you invest, you first think of risk mitigating. If I continue to invest in what I already have, that is not mitigating the risk. Okay. Then different nations have found different nice investment options. Can someone tell me where Qatar would invest? And why I'm asking this is they are investing in something which they don't have. And that is not a category which is highlighted under any of what we so far discussed. They are not investing in arable lands. They are not investing in forex, not on shares. Think another investment option, and let me see that answer quickly. Think another investment option and let us know about it. Yeah. They invest in real estates. They have selected one country, one city, and out of that city, 70% of the floor area, square area of properties belong to them. London, UK's London, commercial properties, most of the commercial properties are purchased by them. I think 1 or 2 years ago, Saudi Arabia all of a sudden blocked air passages for Qatar, saying they are supporting another terrorist group in the world. But Qatar was not affected. They were not allowed to export oil. They were not worried. Why? They have enough income coming out of what they have already diversified. That's where the funds diversification matters. You maintain liquidity, reduce the investment concentration risk, enhance the rate of return. For this purpose, all funds diversify. Even though they concentrate on one main area, still they diversify into different areas. Norwegian Petroleum Fund has perfectly diversified. They are into debt, equity, and real estates. Concentration risk is a banking term describing the level of risk in a bank's portfolio, arising from concentrating into a single counterparty, sector, or a country. The risk arises from the observation that more concentrated portfolios are less diversified, and therefore the return on the underlying assets are more correlated. Okay. Now, think about an individual who was purely depending on tourism-related activities in Sri Lanka. What has happened to him today? So if you concentrate on only one income generating area, that risk is high. That's why you diversify. In Sri Lanka, we can see most of the companies have diversified. Why? Because we have seen risk arising from time to time from different unexpected activities. So most of the businesses prefer to diversify in Sri Lanka. Investment funds, they have to diversify to mitigate the risk. If you depend too much on one area, if that area fails, you'll be at a bursting point. Okay, right. So plan your retirement now. That's the message. Okay, so there was certain questions arise from superannuities. Then we'll move into another area today. Now, last week, when we were discussing papers, we looked into areas we have not discussed so far. So I said leasing, hire purchasing, that part, superannuation, capital adequacy. After that, we may have to discuss on microfinance, cooperative societies. Then we can say we have done the entire syllabus. Capital adequacy. That's another topic we are covering today. Okay. I think we talked about assets and liabilities. A equals C plus L. Okay. So you have asset side and liability side. Okay. What do you mean by assets of a bank? Tell me some examples of asset side of a bank. So in accounts formula, A equals C plus L. Assets equals capital plus liabilities. We talked about it last week. Tell me, what can you consider as assets of a bank? Very good. Loans and advances. Okay. In addition to that, can you keep a little bit of money in treasury bills? If so, is that asset? Say yes or no. Treasury bills? Yes. Can you keep a little bit in cash and cash equivalent and call it asset? Yes or no? Yes. So that's coming under the asset side. Okay. Liabilities. Under liabilities, you have two aspects, C plus L, capital plus liabilities. Yes. Liability side, mostly on deposits. Last week, we looked at owner have to keep a percentage and the balance is coming by general public by the way of deposits. Now we look at how much capital you have to keep against the assets you prefer. Means what? The more you grow in business, the more capital you must expand. If so, the more you give loans, the more owners will feel. If not, what will happen? The more you give loans, the risk is transferred to depositors. If the repayment is good, equity contributor is extremely happy. He can claim enough dividends at the expenses of depositor. To prevent that, capital adequacy is required. Now let's look into capital adequacy. The capital adequacy ratio is a measurement of a bank's available capital expressed as a percentage of bank's risk-weighted credit exposure. The capital adequacy ratio, also known as CAR, capital to risk-weighted asset ratio, is used to protect depositors and promote the stability and efficiency of the financial systems around the world. Okay, how much have the owners contributed against the risk-weighted assets they are undertaking? Now you said all your loans are assets, but do you think that all the loans have same risk component? Now I'll give you 3 examples. Tell me which is very high in risk, which is low in risk, which has no risk. Okay, high, low, no. That should be your answer. So I'm giving you 3 examples. Number 1, here comes a customer who would ask you to take a loan to develop software, and he needs 5 million. Everyone wants 5 million. I'm giving you 3 options. So you give away 5 million to develop a website, just to develop a website. And he said if once he developed this website, he can be rich as maybe Jeff Bezos of Amazon, or maybe like Mark Zuckerberg, right? Just by developing a website, and the bank will give him 5 million. What is the risk? Is it high, low? Number 2, here comes a customer who want to get 5 million leasing facility for school van. When the schools restart, we find, okay, let's say he's out of Western province, so the schools are already in operation, and he need 5 million to run a school van. So the facility is a leasing facility, absolute ownership gets into the bank. Now the third person, he also want 5 million, but he's asking it against his own FD of 10 million. He has deposited 10 million with your bank, and he's asking another 5 million as a loan against fixed deposit, his own fixed deposit. Okay, rank me high, low, no. Is 1 high, 2 high, 3 high, or likewise? Send me different risk weights. Okay, so I'm asking you to risk weight these assets. You said your loans assets. Now these 3 are your assets. All of them are loans, advances. Now risk weight and tell me high, low, no. So you can say 1 high, low, or no. Number 2 high, low, or no. Number 3, what is your thinking? Send me your answers now. Okay, so good. Now you can get an idea of what is meant by risk-weighted assets. All of them are assets because all of them are loans. Okay, but you can see certain assets, no risk at all. Certain assets, the risk is low. Certain assets, the risk is very high. When you give a loan for without any security, like software, risk is very high. Okay, good. That's what we are looking at. To promote stability and efficiency of the financial system around the world. The Basel Committee of Banking Supervision. Basel is a city, and the bankers get together into city to look into the risks. It's a committee of banking supervisory authorities that was established by CBSL, governors of the, central bank governors of the group of 10 countries in 1974. The committee expanded its membership in 2009 and then again in 2019. The Basel Committee of Bank Supervision now has 45 members from 28 jurisdictions, consisting of central banks and authorities with responsibility of banking regulations. Provides a forum for regular cooperation on banking supervisory matters. Its objectives is to enhance understanding of key supervisory issues and improve the quality of banking supervision worldwide. The committee frames guidelines and standards in different areas. Some of the better known among them are the international standards for capital adequacy, the core principles for effective banking supervision, and concordate on cross-border banking supervision. Okay, so at Basel, now that's the building, central bankers get together and decide on capital adequacy. So this city is, the Basel city is located in Switzerland. The Bank for International Settlements host and support the get together of them. Two types of capital are measured. One is called tier 1, in other words, core capital, the central, main set. The other is tier 2, we call it supplementary capital. Okay, tier 1 capital, core capital, which can absorb losses without a bank being required to cease trading. Okay, so while running the business, how can we meet the risk? Tier 2 capital, which can absorb losses in the event of winding up. Okay, so if we are no more running the business and we want to wind up, but how can we protect the depositors on such instance? So that is the meaning. How do we calculate the capital adequacy ratios? The capital adequacy ratio is calculated by dividing bank's capital by its risk-weighted assets. The capital used to calculate the capital adequacy ratio is divided into two tiers. So capital adequacy ratio is T1, T2 divided by risk-weighted assets. Now you know that assets can be risk-weighted. You know that capital can be considered as core because they belongs to the center. Tier 2 capital, when you liquidate the business, still you don't want to transfer much to depositors. That's where tier 2 capital comes. Tier 1 capital, in other words, is core capital, consists of equity capital, ordinary share capital, intangible assets, and audited revenue reserves. Tier 1 capital is used to absorb losses and does not require bank to cease operations. Tier 1 capital is the capital that is permanently and easily available to cushion losses suffered by a bank without it being required to stop operating. A good example of a bank's tier 1 capital is its ordinary share capital. Okay, so owners are not going to withdraw their money. So that's a very good cushion against the risk you undertake. Elements of tier 1 capital, something for your paper. Paid up and authorized ordinary shares, statutory reserves, general reserves, non-redeemable, non-cumulative preference shares. Then published profit and loss, unpublished profit and loss. Okay, so these are the elements of tier 1 capital. Tier 2 capital. Tier 2 capital comprises unaudited retained earnings, unaudited reserves, and general loss reserves. The capital absorbs losses in the event of a company winding up or liquidating. Okay, so this is important when you are winding up the company. Tier 2 capital is the one that cushions losses in the case the bank is winding up. So it provides a lesser degree of protection to depositors and creditors. It is used to absorb losses if a bank loses all its tier 1 capital. Okay, so if all tier 1 capital is lost, then the second cushion coming from tier 2 capital. So the elements: undisclosed reserves, subordinated debt, hybrid instruments, that is redeemable cumulative preference shares, general provisions, and revaluation reserves. The two capital tiers are added together and divided by risk-weighted assets to calculate capital adequacy ratio. Risk-weighted assets are calculated by looking at the bank's loans, evaluated the risk, and then assigning a weight. Okay, so the assets are also risk-weighted, something like what we did now. When measuring the credit exposure, the adjustments are made to the value of its assets listed on a lender's balance sheet. All of the loans the bank has issued are weighted based on their degree of credit risk. For an example, loans issued by the governments are weighted at 0 risk, while those who given to individuals and assigned a weight score of 100%. Now we are looking at the asset side. First, we look at the capital side. Risk-weighted assets are used to determine the minimum amount of capital that must be held by banks and other institutions to reduce the risk of insolvency. The capital requirement is based on a risk assessment of each type of bank asset. For example, a loan that is secured by a letter of credit is considered to be a riskier. Okay, so if you are then and request more capital than a mortgage loan that is secured with a collateral. So if you give clean loans, that is definitely higher risk than something which is securitized. Okay. Why capital adequacy ratio matters? Okay. Now, why do you want to measure these capital adequacy ratios? The more a company is growing, if the owners are not increasing their contribution, they will tend to undertake extremely high risk at the cost of depositors. If a company asset is growing, means what? If you are giving more and more loans, then the owners must also feel that they will be running into risk if these loans are not paid by the customer. If they don't feel that, they prefer to see more growth. Risk is overtaking your ability to absorb the risk. Why capital adequacy ratio matters? The reason minimum capital adequacy ratio are critical is to make sure that banks have enough cushion to absorb reasonable amount of losses before they become insolvent and consequently lose depositors' money. The capital adequacy ratio ensures the efficiency and stability of a nation's financial system by lowering the risk of banks becoming insolvent. Now, if a bank fails, then general public lose faith in the whole banking system. We have seen again and again in the world bank runs. Bank run means depositors are flocking to withdraw money because they lose faith in the banking system. They are not waiting until their deposits get matured. They want it now. And no bank can honor all the withdrawals at once. If all the depositors are asking their deposited money at once, no bank can meet that requirement and the bank will definitely collapse. When one collapses, the entire system collapses. That's why capital adequacy matters. Generally, a bank with a high capital adequacy ratio is considered safe and likely to meet its financial obligations. During the process of winding up, funds belonging to depositors are given a higher priority than the bank's capital. Yes. So depositors can only lose their savings if a bank registers a loss exceeding the amount of capital it possesses. Okay. So depositors will get their entire amount back if the capital is enough. If only the capital is enough. Thus, the higher the bank's capital adequacy ratio, the higher the degree of protection of depositors' assets. Then there are off-balance sheet agreements such as foreign exchange contracts and guarantees also have a credit risk. Such exposures are converted to their credit equivalent figures and then weighted in a similar fashion so that of on-balance sheet credit exposures. The off-balance sheet and on-balance sheet credit exposures are then lumped together to obtain the total risk-weighted credit exposure. Capital adequacy ratio versus solvency ratio. Okay. So capital adequacy ratio looks into the risk weight against the loans you are giving. Okay, there are certain instances in the world where banks failed, collapsed. When one fails, that creates repercussion on other banks. We have seen again and again when people get fear in their mind. When they lose trust with the banking system, they won't withdraw money. The faster they start to withdraw, the whole system collapse. 2008, we have seen global recession due to this kind of behavior. One after the other, big finance companies and banks started to collapse. So that started in US, but the entire world was affected by that. That was the last we have seen. But unless this capital adequacy ratio and the strengthening of the financial system takes place, there can be another wave of such failures. Now we are looking at capital adequacy ratio versus solvency ratio. Okay, first rate it. Good morning. Yes. Okay. Okay, so there's a difference between capital adequacy ratio and solvency ratio. Both the capital adequacy ratio and the solvency ratio provide ways to evaluate companies' debt versus its revenue situation. However, the capital adequacy ratio is usually applied specifically to evaluate banks, while the solvency ratio metric can be used for evaluating any type of company. Okay, so capital adequacy ratio matters only in banks, but solvency can be used for any institution, especially in insurance. You are using solvency ratio. The solvency ratio is a debt evaluation metric that can be applied to any type of company to assess how well it can cover both its short-term and long-term outstanding financial obligations. Solvency ratios below 20% indicate an increasing likelihood of default. Analysts often favor the solvency ratio for providing a comprehensive evaluation of company's financial situation because it measures actual cash flow rather than net income, not all of which may be really available to a company to meet obligations. The solvency ratio is best employed in comparison with similar firms within the same industry, as certain industries tend to significantly more debt heavy than others. Okay, so solvency ratio looks into your ability to remain in business and to generate cash. Okay, so this is a cartoon after the collapsing of banks in 2008. So it's like, okay, after 2008, the safety nets were created to protect the banks. But the cartoonist shows it's like those who aren't sinking. Announcement comes to select a category. If you are the owner of the ship, it's investor, sorry, it's captain, it's investor or the manufacturer, then you will be safeguarded. Now that should not be the case. The passengers should be safeguarded, not the owner and the captain. If the ship capsized, the failure is not the passengers, but the manufacturer and the captain. Okay, we'll get back to business. Generally speaking, these rules mean that the greater risk which the bank is exposed, the greater the amount of capital the bank needs to hold to safeguard its solvency and overall economic stability. Okay, the more risk you are exposed, the more capital you must keep. Basel Committee from time to time changed their percentages, changed their way of giving guidelines. So by now we have Basel III guidelines. So these guidelines are named Basel I, Basel II. Now what we have to apply is Basel III. Okay, so that was, the earlier one was Basel II. These three pillars. Now as per Basel guidelines, there are three pillars. The three pillars are minimum capital requirement, supervisory review, and market discipline. Okay, so it's like a building based on 3 pillars. It's like our traditional cooking pot, where you have 3 cornerstones, and on top you place a pot. In the same way, you have to look at 3 pillars to maintain the stability of the system. The first pillar maintains the regulated capital for 3 components of risk. You can easily remember them as .com, C-O-M, com. Credit, operational, market. Second pillar, okay, so it looks into the regulatory response for the first pillar. Much improved tools over those available to them under Basel I. It is also provide a framework for dealing with other risks. We talked about .com, credit, operational, market risk. Then the other risk, systemic concentration, liquidity, and legal risk. The third pillar, which is called market discipline, means what? You must disclose your information. So let the market decide. So market disciplining is like giving your results. So your parents will decide what to do with the way you have earned marks. The third pillar requires the bank activities to transparent to general public. Okay. Now, there was a time, there were a lot of finance companies which were not listed in Colombo Stock Exchange. Then almost all of them were asked to get listed. When you list a company, what is the advantage to the general public? Okay. Now you are the depositor of a finance company, and that finance company is not a listed company. Then they were asked to get listed. Now you are the depositor of a listed finance company. What is the advantage you get when a company gets listed? Okay, as a depositor, what is that?
Safety.
Sorry.
Safety,
Yeah, how do you get safety?
because it is listed and also the risk is mitigated.
Yeah, how do you get the risk mitigated? Just by listing. What is the difference
I
of?
know.
Yeah, tell me. Go ahead.
Actually, the shares are not only one person owning, because there are so many shareholders.
Okay, now depositors and shareholders are 2 different categories. Okay, depositors, they come to the bank against a piece of paper called fixed deposit, they give away money. Shareholders, they buy the listed shares. Okay, so there are 2 different categories. Now market disciplining happens when a company is listed. Okay, what is the advantage you, the depositor, get when a bank or a finance company is listed? Remember, when you get listed, the best advantage is your financial statements have to be published. Okay, your financial statements now published in CSC website. Okay. Earlier, you go and deposit in a company where you don't see income statement, balance sheet, or cash flow statement. Okay, when you are depositing money, you don't see any of this information. But the moment that company get listed, each quarter they have to publish in the Colombo Stock Exchange website their financials. Okay. Now think about a small microfinance company, Wimput Finance. It's a listed company. In one particular year, that was 2015, they started to show huge sudden growth. Okay. And that was a listed company. The share price started to shot up, and the financials, annual reports, They were published. Now we can read them, we can see them. Then there were arguments in certain websites. Some argued this sudden huge increase in revenue and profit will become a burden if loans were given without proper credit evaluation. Now this company is in loss. Okay. Means what? Now the share price has fallen. Okay. Why do you think the share price has fallen? Because as a shareholder, you know that you will not be entitled for the dividend, and the share price falls. Means what? Share price itself indicate to the management shareholders are not interested. Depositors, on the other hand, now they can read the annual report, quarter report. They can go to the income statement, balance sheet, cash flow statement, ratios, and other compulsory, mandatory disclosures. Then they decide, okay, I'm not going to buy share of this XYZ finance company. I have read their annual reports, I have read their financials. No, they are not strong. I'm not happy with the capital adequacy ratio. They have to go for the right issue, and they are not managing well. So the market is disciplining them. Now that is the advantage you get. Okay. The third pillar requires a bank activity to be transparent to the general public. Means what? Go and show your accounts to the general public. When someone comes to your bank to deposit his money, he's not asking, okay, I want to see your balance sheet, I want to see your income statement. But when a company gets listed, that's mandated to publish this information. For this, bank is supposed to release relevant financial data in a timely manner to the general public through its web page. So you go to CSC website, look at how Sampath Bank is performing, how Commercial Bank is performing, how Central Finance is performing. Then you compare them. You look at capital adequacy ratio. Central Finance capital adequacy ratio is the highest in the market. Now you get such information. Why? Because they are listed. Okay, so that is the importance of listing. This might enable depositors to better evaluate the bank condition and diversify their portfolio accordingly. As such, the pillar by itself is believed will enhance the role of market discipline in the financial markets. Okay, this pillar believes disclosure. The pillar is purely on disclosing financial statements. What we believe is general public will read this information and they will sell out or buy shares based on the performance. When a large number of investors start to sell out, what will happen to the share price? It comes down, plummet. When it falls down, the management gets the view, okay, this company is not managing. We are not doing our job. Okay. Market discipline. First you read it, after that we'll discuss. Please read it. Okay. Market discipline. Bank managers, they are measured by the profits that they undertake, the profits that they give. So bank managers will behave in a manner where they want to give more and more loans without proper credit evaluation. In a short run, you can show massive growth. I said Bimput, 2015, 500 million to 2 billion. Very good, amazing. Next one. Okay. Now read the next slide, then we'll discuss. one might suspect if this is in fact case of whether market discipline really exists or not. After all, depositors are under some sort of government guarantee anyway. Okay. We have discussed about what? Depositors insurance scheme. So if you are the depositor less than 600,000 in Sri Lanka, let's say you have only 500,000, you need not to worry about financial state. Why? The government guarantees there. In fact, there are even implicit insurance schemes like too big to fail, where regulators in central agencies feel obliged to rescue a troubled bank with fear of financial contagion. Okay. In addition to that, you believe if I deposit in a very big bank, government will never allow that bank to fail. Okay. Now, sometimes back, there was a question in that was financial clients management or some other subject. The question was, when Pramukha Bank failed, government did not intervene much. But when they sense, they have given the name. Okay. Ceylon Bank is facing some problems. Government immediately intervened. Why? So the expected answer is small banks failure will not have much impact on the economy. But
So can you repeat the question?
okay, now sometimes back there was a question like this in a particular paper, and I think the paper is financial client management. Okay, the question was a practical one. When Pramukha Bank failed, there were less efforts than the indications of Ceylon Bank. So in 2008, 2009, there were certain indications. Okay, Ceylon Bank's NPL ratio was very high, and some other indications. Immediately, government intervened, central bank intervened. But when Pramukha failed, that was allowed to fail. Why? Okay. So the expected answer was small banks, when they fail, the impact is less. But when big banks fail, the impact is to the national economy is very high. Therefore, immediate actions are required. Now, the same happens everywhere. So we call it too big to fail. Think about US in 2008. Small banks and finance companies, okay, Freddie Mac, then Bear Stearns, they really collapsed. Bear Stearns collapsed, but no intervention. Next, Goldman Sachs, General Insurance, they were on the cards to fail. It was expected these huge financial institutions in US will fail on Monday. So on the weekend, the regulators, Federal Reserves and Treasury, they got together in US, discussed throughout this weekend, and finally came up a bailout package Sunday evening. 7 billion bailout package, and 10%, 700 million was given to Goldman Sachs. And people did not want to withdraw money from Goldman Sachs. Means what? Goldman Sachs was too big to fail, and government intervened immediately. General public feels that. Okay. If so, they are not worried much about investing in big banks. They know if a small bank fails, there is a problem. Why then depositors bother to monitor bank activities under these favorable circumstances? Okay. So we are talking about market disciplining. What is market disciplining? We believe that if a bank fails, if a bank performing in a risky manner, depositors will immediately withdraw money, and the shareholders will sell their shares at lower levels. That itself will become an indicator to the management. That is what we believe as market discipline. Here the argument is, no, the depositors will not behave in such a manner. Number one, if they invest in small, if they deposit in small banks and in small quantities, let's say in Sri Lanka, you invest in CIFL and your the deposited amount is 300,000, you definitely know, even if CIFL fails, the bank will, central or the government will honor your 300,000. You are covered by deposit insurance, so you are not worried. If a big bank fails in Sri Lanka, you know that before it collapses, government will intervene and somehow protect it. So if you are a depositor, why you want to worry about? Why do you want to worry about these things? Because you are protected. Therefore, making the relevant financial data publicly available in a timely fashion will supposedly help investors to better evaluate bank condition by themselves. And such things will relieve the pressure on the regulator and put it in the shoulder of market investors and depositors. Okay. So market disciplining believe that market investor and depositor will shoulder the responsibility. But one thing is sure, shareholder will not go and buy shares of companies that show declining profit, negative profits. So that will discipline the management. The right amount of information release is essential. Okay, we are talking about capital adequacy. Then we started to talk about Basel. Under Basel III, the third pillar is market disciplining. Under market disciplining, we believe if the depositors and investors get the right amount of information, they will act in a manner to discipline the management. Okay, share price is going down, so the managers would get together and discuss how, why, what can we do. Okay, to do that, right amount of information should be released. With too little information, there is no discipline. If there is too much of information, again, there must be devastating consequences. Okay, so the amount of information is defined, and only that is published in website. Okay, so you will find financial statements, then some other information like ratios, then top 20 shareholders list. Only the relevant information is provided in a timely manner. Now we are looking at different. We talked about different types of risk. Credit risk. When I'm giving away credit, I'm worried about whether the customer will pay back. That is the credit risk. Okay. Operational risk. Frauds can take place, and some cashiers can play fool. Those who go out and to do recoveries can collect money from the customers and do not deposit it, do not take them into the bank. That's a risk. Your area where your head office is located can be isolated due to COVID-19. That's a risk. Okay. Your information system is hacked. That's a risk. So that's operational risk. So credit risk look into when I'm giving away loan, can the customers pay back? Operational risk on operational matters. Market risk, okay, everything is fine, but the share market goes up, comes down, vehicle value goes up, comes down, the properties which you have mortgage goes up, comes down, the gold which you have pawned, the share price goes, gold price goes up, comes down. That's market risk. Okay. Equity risk, stock prices will come down. Interest rate risk. Okay, currency, American dollar, will it appreciate? Sri Lankan dollar, will it depreciate further? Risk. Commodity. Okay, gold price in the market, will it go further up or will it come down? Will there be a bubble burst in gold? Commodity risk. Okay, credit risk or the finance risk, the spreads. Okay, so when you give a deposit and when you accept deposit at an interest rate, and when you give loans against that, there's a spread. That is your NIM, net interest margin. That is also subject to changes. Okay, so we were looking into that types of risks. Then concentration risk. You concentrate on one item, one area. If that fails, suppose you are giving all the loans to tourism. One year it was Saharan's attack, next year that was COVID-19. 2 good years have lost, and you can't remain in business. Why? You have concentrated on only one thing, concentration risk. Okay, now we are once again looking at capital adequacy. A bank capital is required as a cushion to absorb losses, which should be borne by shareholders than transferring them to depositors. Okay, so you can go through this, almost the same thing again I'm giving you. Okay, so we have looked at bank's balance sheet. You have asset side and capital plus debt. Okay, liabilities. Altogether you call them liabilities. Assets is equal to liabilities. What are assets? The loans, the investments, and the cash. Then what is capital? The owner's money plus the retained profit. What are your assets? What are your liabilities? Other liabilities? The loans you have obtained, depositors, and debt securities like debentures. They are going to be your liability side. Right. Then capital adequacy ratio. I have not. Okay. So I have not given the percentages. I have made it X and Y, and I leave it you to look into the capital adequacy ratios applicable to banks and finance companies. Okay. You have to find that. Anyway, I'll give you this at the moment. Licensed finance companies, if your assets are less than 100 billion, core capital 6%, then you have to increase. By 2020 July, it must be 7%. By 2021, it must be 8.5. Then supplementary capital percentages. Now assets more than 100 billion, less than 100 billion. Okay. So categories. Right. Next, the harmonization of capital adequacy norms across the world. Throughout the world, entire banks and finance system is looking into capital adequacy. So no one is safeguarding, no one is foolproof. If the system is not applied throughout the world, then the manipulators will find safe havens. Here it is not the case. Entire world banking system is strengthened to ensure the banking across the globe would be able to withstand any problem. We have seen in 2008 what happened in US when Bear Stearns failed, when Freddie Mac failed, and next some of the French banks started to collapse one by one. Rest of the country's banking system started to collapse. But if you have this Basel perfectly in place, then throughout the world, the entire banking system will be protected. Because one fails, the world is suffering. Especially in a developed country, if a big bank fails, that will definitely affect to the entire global banking system. To provide an equal base for banks in the world to compete. To remove the incentive, a bank may have to relocate another country due to leniency in regulations. Okay. It is very difficult to do banking in XYZ country. Their rules and regulations are so perfect. So I move into another country where they don't have much rules, but I can increase my profitability. No, that is not the case. Entire world, banks are connected. Entire world, what happens to one bank affects to another. If so, the entire system should be strengthened. Okay. Tier 1 capital. Elements of core capital. You must remember this. Next week I'll ask, what are the elements of Tier 1 capital? What are the elements of Tier 2 capital? How do you calculate the risk weight? Now, we talked about risk-weighted assets. Certain assets are zero risk: cash, gold bullion, treasury bills, central bank securities. You already said, when I ask someone who is having 7 million in fixed deposit, takes a loan against that 5 million, you said zero risk. Yes, that is there. Loans against cash deposits, risk weight is zero. Then 10%, 20%, 50, 100. Okay, off balance sheet example. How do you calculate that? Okay, so with that, I'll enter two main areas today. One is superannuities, the other is capital adequacy ratios. Okay, we'll start another one. So definitely we will not be able to complete the whole thing. If so, we can read the next week, continue. Leasing. Right. Now before that, have you heard? Okay. Now who is the person who has innovated sewing machines? Can someone tell me who is the innovator of sewing machines? When I say sewing machines, what is the brand that comes to your mind in Sri Lanka? Okay. Now these days we all purchase clothes. Very good. That is the answer. Singer. Okay. Now you have said, okay, 50% to my first question, who has innovated sewing machines? My question is, who has innovated sewing machines? And your answer, Singer, is 50%. Okay. So Isaac Singer is the person who innovated sewing machines in US. Okay. But the story is slightly different. Okay. There was a guy staying in UK, Elias Harvey. He innovated the world's first sewing machine, but he was not a gifted business person, gifted business guy. He was just a lazy innovator. He innovated the first sewing machine, manufactured, sold few of them, and was not running a good business. He was in debt. When his wife died, he has attended to the funeral wearing borrowed clothes. Right? The guy who has innovated the world's first sewing machine could not afford to purchase clothes. Such a poor person. However, one of these machines which he has manufactured went to US, and the machine needed certain repairs. Isaac Singer was a person who was running an advertising firm. Let's say he was fixing name boards, a technician. So the person who has purchased a sewing machine went to Isaac Singer to repair it because he's a technician. Isaac Singer looked at the machine and he did simple changes to the machine. Then he went to the patent rights department of US, got patent license for sewing machine, and he named the machine Singer machine. Then he's a brilliant, gifted business person. He started a factory in US to manufacture sewing machines, Singer sewing machines. He found the machine is expensive and the poor housewives cannot afford it. So he came up with a nice proposal. You pay me 1/3, the balance you pay as you go on. You can even make a living by sewing clothes. Pay as you earn. So he came up with a nice concept, hire purchase. Singer, hire purchase. Even now you will find a lot of electronic items are sold on hire purchase basis. Hired, but intention is to purchase. He expanded his sales. Then he started factories all over the Europe, in France, in UK. He started a factory. By now, Elias Harvey found Almost the same machine he has innovated is being sold under another brand name. He went to courts, and finally both came to an agreement, settled. But whatever it is, Isaac Singer not just copied the machine, sold the machine perfectly well. When selling, he found people cannot afford the machine, so he came up with a solution that is hire purchasing contracts. In addition to that, he became the world's first multinational company owner. He had factories in different countries. Okay, right. With this explanation, let's look at our leasing and hire purchasing business. Finance lease means the business of investing money for the provision of equipment under finance lease. Here you have three parties: lessor, lessee, and the supplier. Lessor, in relation to finance lease, means the person who transfers the right to possession and use of equipment under lease to a lessee. Simply remember, lessor is the bank or the finance company. Lessee, simply remember the customer. Okay, so the customer possess, okay, means a person who acquires the right to possession and use. In real, the customer gets the right to use the asset without owning it. Okay. Under leasing, you have two types of leasing. Now, when we looked at past papers, there were questions from this area, so you have to go through it seriously. In real, leasing means absolute ownership lies with the bank, lessor. Lessee is just the user. He can use the asset and earn and pay back. When it comes to hire purchase, the more you pay, the more you get the ownership. But under leasing, even if you pay the last rental, you are not the owner. Ownership lies with the bank. But as a practice, we transfer, we allow the transfer, we give a no objection letter and say, okay, finally, get it transferred to your name. We don't object that. Means what? It's not legally binding for the mandatory transfer, but we said we don't have objection of transferring it after fully settling. Means what? We are the absolute owner. The bank or the finance company is the absolute owner. That's finance leasing. So the person who takes the vehicle under finance leasing, he has to insure it. He has to service it. He has to use it. He has to repair it. At the same time, we find another demand is emerging without the intention of owning the asset. Right? So there is no option to transfer the asset. That is operating lease. Let's see the differences. Ownership for operating lease with the bank. For finance leasing, there is an option. Okay, so remember that very clearly. It's not mandatory, but there is option. Right? At the end to transfer. Here, no option at all. The ownership only with the bank. The risk and rewards with the bank. The risk and reward with the user. Means what? Now, what is the risk? I buy a vehicle. When I want to sell the vehicle, finally, I find the market rate has gone down. That is the risk. I take a loan against a vehicle, and when I finally fully settle, I have the option of getting the ownership. I get the ownership and I want to sell it, and I sell it at a very good profit. Means what? The reward is with me, the customer. Operating lease, the risk and reward both with the bank. Here, under financial leasing, both with the customer. Purchasing option. Under operating lease, not at any cost. There is no option. But for finance lease, yes, definitely there is option. expenses by the bank, by the customer. Running cost means what? You have to run the vehicle, repair it, service it. Okay, so that belongs to, okay, no running or administration costs. Running cost and administration expenses are higher. Tax benefit, no depreciation can be claimed. Okay, customer cannot claim any depreciation. Why? Because he is not going to own it. Here, interest and depreciation can be both claimed from tax part. Why? You are going to own it one day, right? Then capital lease and operating lease, you must know the differences. Okay, let me talk a little bit on operating lease. Operating lease means I am giving a facility to the customer where he can use the vehicle. He is only the user, but he cannot own it. But I give him some other advantages. Suppose he meet with an accident. I, the owner, the bank, will take this vehicle to the repair center. And for the days the vehicle is staying in under the garage, I'll give another vehicle to use. That's under operating lease. Under finance lease, that has nothing to do with the bank. Either you use it, or even if you don't use it, I'm not responsible. Under operating lease, servicing the vehicle, repairing the vehicle, maintaining it, everything is with the bank. Customer is only using. And if we fail to, on our service day, we'll take the vehicle from the customer and give him another vehicle for using. Why? Customer is only worried on using. He is not at all looking into ownership options. I'll insure it, I'll claim, everything is by me. But finance leasing, customer enters with the intention of owning one day. Remember, it's only option. The bank can decide not to transfer. There's no such thing called automatic transfer, but the option is there. So the bank is not looking into repairs, insurance, servicing of the vehicle, no way of handling an optional vehicle to him, alternative vehicle, nothing. That's purely by the customer. So there is a difference between finance lease and operating lease. Now securitization. Under leasing, you are the absolute owner. Okay. Under finance lease, the bank is the absolute owner. Means what? Even though someone is using the vehicle I own, I am the owner. If I am the owner, I can mortgage it. Okay. Right. I have given you the vehicle. The book is with me. The RMB registered book, CR copies with me. I can bundle a set of CR copies and go to another bank and get a loan. Why? That's my asset. Okay, so that is securitization. Means issuance of securities by a special purpose vehicle which are backed by an asset consisting of any or all the rights in a finance lease or any equipment forming the subject matter of a finance leasing or both, transferred or assigned by lessor in favor of such special purpose vehicle. Special purpose vehicle, now it's not a physical vehicle, okay? It means a body, corporate or unincorporated, including a trust, established solely for the purpose of securitizing. Okay, so in our lease agreements, we have a supplier. Okay? Supplier means a person who supplies an equipment for the purpose of finance lease, but does not include a lessee, where the lessee supplies such equipment. Okay, so you have three parties: lessor, lessee, and the supplier. Then there is an agreement called supply agreement. Okay. This one we'll discuss later. Right. So under Finance Leasing Act, you have three parties: lessee, lessor, supplier. Okay. You can go through them. Right. Cancelling, suspending. Duties of different parties. Okay. Lessee has a right to undistributed and peaceful possession. Okay. Lessee, let's say school van owner. undistributed and peaceful possession, okay, he can run his business. A three-wheeler person, he can run his business. He can decide whether to work today or not. That's entirely up to him. Okay. He can use the vehicle. Now that's with the supplier. If he fails to delivery, no late delivery. So supplier has a part. Lessee's acceptance of equipment. Okay. Now the supplier is showing the vehicle, transferring it, and handing over the vehicle from the sales center to the customer. Customer accept. Where the customer accept the equipment provided under finance lease, the terms and conditions of the lease shall be irrevocably thereafter. Okay. The moment customer accept, hereafter you have to pay. Okay. Now the vehicle is handed over to you at the car sale, supplier. Hereafter, the moment the vehicle is handed over, customer is bound to pay back. Return of the equipment. In certain areas, yes, you can return the equipment. Supply agreement, okay, go through it. Non-liability of lessor for loss in relation to equipment. Lessor, the bank, shall not incur any liability to the lessee for any loss suffered by the lessee in respect of equipment provided under the finance lease, except to the extent of any loss arising out of the lessee's reliance on the lessor's skill and judgment on the selection. Okay. Now comes seizing. Okay. So we have seen last year, media labeled finance leasing as leasing mafia. Okay. There was a very sad incident. Unauthorized leasing company killed a customer, and with that there was much of discussion on leasing business. Unlike other mortgage assets, here the absolute ownership lies with the bank. Therefore, bank can take the vehicle asset back. Okay. So that was on discussion. Customer get the vehicle with the understanding to pay back. But what happens if he does not pay back? So you call it default. If the customer default by lessee, where the lessee fails to comply with certain conditions of the finance lease in such circumstances as would amount to a substantial failure of such, the lessor may, subject to provisions of Section 21, require the lessee to make accelerated payment, or if that is not happening, terminate and recover and repossess and claim damages. Right. So that's there. If a substantial repayment is not taking place, the absolute owner can repossess the vehicle. Further, if he sells, if he can't recover fully the balance, he can claim from the customer. Accelerated payments or termination with notice to lessee. Okay, he's not paying. I'm asking him to accelerate the payment, and I can terminate now. Why? He has breached the contract between the two parties. Okay, so one definite condition is paying. You have not paid. You have not paid on time. If so, you have breached the contract between the bank and the customer. Specifying the circumstances which had caused a substantial failure. Appoint a date not being less than 7 days. Where lessee fails to remedy the failure. Okay. You sell and computation of damages. A finance lease may provide to the manner in which damage is recoverable. Due diligence. Okay, you have to do your homework. You have to do your own assessments. A lessor shall not be entitled to recover under paragraph such damages which the lessor could have consideration of circumstances avoid the exercise due diligence. Transferring of lessor's rights. Okay, now this is where the securitization comes, and the special purpose vehicle means it's not a physical vehicle. Okay, it's an instrument. Then transferring of the lessee's rights in the equipment. A lessee, the customer, shall not accept the written permission of the bank subject to any rights of third parties transfer the possession. Okay. Lessee's trust is in bankruptcy recovery of possession. A lessor, the bank, who becomes entitled to recover the possession of the equipment under this act, notify such right to voice in the police of the nearest area, obtain the assistance of a police officer, and recover and peacefully repossess the asset. If that is not taking place, you can repossess through court order. Okay, right. Now we have covered many areas so far. What remains is microfinance and cooperative societies. After that, we can say we have completed the entire syllabus. Then under capital adequacy, last few papers showed some calculations. So we'll do a calculation later. For the time being, you must remember the elements of tier 1 capital and tier 2 capital. Then risk weight, zero weighted assets, what are they? Cash and cash equivalent, then the treasury bills, gold and bullion. That you have to remember. 10%, 20%, 50%, 100% risk weighted assets, what are they? Then you have to remember the directions. Last week we talked about directions. Okay, so go through these directions seriously. Before that, we talked about corporate governance. Then I showed you how corporate governance is tested in past papers. Now it's your duty to look at all the notes, all the slides we have discussed. In addition to that, I asked you to get updated on recent publications. I'll show you something which I will make it available for the reading purpose next week. Now this is appearing in Sunday Times, last week Sunday Times. There was a very good article. Is corporate governance the panacea for finance company yields? What do you mean by panacea? Okay, so this was a very good article. I'll make it available for you to read. So the question is corporate governance? And I said in recent papers, the corporate governance is often tested. So the article is titled like this: is corporate governance the panacea for finance company yields? That's how the article is titled. Okay. Right. So panacea means medicine for all illnesses. Right. Now, if you have a panacea, you can apply the same. Okay. Suppose you have one tablet for COVID-19, for dengue, for rheumatic fever, for cough, whatever the illnesses you have, stomach ache, for everything, only one tablet. Okay, Is it a reality? Say yes or no. Do you think there is only one tablet for all the illnesses in the world? No. Okay. Right. So theoretically, can corporate governance be the only one pill to solve all the illnesses in finance company? So that is the article. Anyway, that shows you one thing. Corporate governance, the more perfectly a company is managed, that will remove out a lot of possibilities of failures. So that's a good article. I'll read out some subheadings there. Why I'm doing that? Because I want to show you that you have to get updated. Role and the responsibilities of the chair and the CEO. That's a topic we have discussed in the class. Compliance function. Okay. Group governance. We talked about related parties, subsidiaries, then the company, holding companies. Ethics and whistleblowing. Okay. Whistleblowing is something I think we missed discussing. Whistleblowing. I'll make it available for reading next week, but for the time being, I'll just read out. Another interesting provision in the consultation paper in the requirement to adopt a code of ethics, which provides guidelines on appropriate conduct and disallowing activities such as fraud, money laundering, bribery and corruption, etc. Emphasizing the need for a corporate culture with strong governance focus. LFCs have also been mandated to establish a whistleblowing policy to ensure that legitimate concerns can be objectively investigated and addressed. Okay, whistleblowing. Someone, an employee, notices something which he suspects, which he smells fishy, then he can make a note of it. Okay. So I'll give you an example which I heard very recently. You have heard about 9/11 attack. Some terrorists came to US and they got hold of a set of 2 aeroplanes and they bombed and they really crashed it on buildings. Okay. Later on, it was found out these terrorists who came to US each and every day went to an ATM machine and they withdraw the highest possible amount allowed on daily basis. Okay. That is something unusual. Suppose you have 5 million in your account. Someone has deposited 5 million in your account. You can go to the bank and withdraw this 5 million citing reasons. But here, these terrorists, knowing the purpose of using money, the purpose, they knew they belong to terrorist group, and if they go to the bank and make appearances, they will appear on CCTV cameras and will be noticed by someone. To avoid that, every day they were withdrawing the highest possible amount from ATM machine. Okay. Something unusual. If an employee notices that, he can take it to the top. Let's say credit card. Credit cards are meant to use as a line of credit. And suppose your credit card limit is 500,000. There comes a customer who is not using credit card to purchase any goods or services. Instead, he is topping up, he is depositing a lot of money in this account. So credit balance, instead of having a balance to pay, he says excess money, 3 million. Something unusual. Okay. Something is behind that. If someone suspects these kind of things, can he take note of it? Remember, Sri Lanka is located in such a good and bad geographical place, and now you know the repercussions. even the government cannot decide, okay, its economic activities. Windmills. Now, yesterday we got a nice message. Windforce announces LKR 3.2 billion IPO to boost renewable energy in Sri Lanka. Okay, so there comes a company that is going to have windmills, a private company, and list in Colombo Stock Exchange where in near future. Right? But when there were projects on fixing windmills in certain islands in North, India is opposing. Sri Lanka is located in a very good naval base, but harbor development, China and India fighting, and government find it very difficult to take decision. That's at the government level. Think about the amount of drugs found in Sri Lanka. Okay. So definitely they are not really meant for Sri Lankans, but they are on transit, huge quantities on transit. After ending the war, now Sri Lanka has become an area for all these mafia guys in the world to do business. Money laundering can take place when this much of drugs found in Sri Lanka. Right? Even in US, the terrorists use the banking system to fund their terrorist activities. That should not take place. Okay. Money laundering looks into a mechanism of preventing illegal activities taking place. Almost all the illegal activities need huge funds, be it terrorism, be it drug trafficking. You need a huge amount of money, and the ideal thing is using banking system. But if the officers of banks are vigilant, then they can help to prevent such incidents taking place. Then there is another good article, pyramids. Have we discussed about pyramids in any of these classes? Anyway, I'll make that's an announcement by CBSL on pyramids. Have we discussed about pyramid schemes in any of these sessions earlier? Say yes or no. Okay, right. Anyway, I'll make this article available for reading, but I'll discuss a little bit more on pyramid. Right. Have we discussed something on Ponzi schemes? You know about Ponzi schemes? Say yes or no. Have you heard this term? No. Okay, right, fine. I'll do maybe a few slides on that. Right. For the time being, just remember this. Now, this one says, special notice to general public, don't trap yourself in a pyramid. Save your hard-earned money. Central Bank has observed that there is a growing tendency of collecting money from the general public through illegal means by promoting prohibited schemes in various places of the country and through the internet. Okay, so internet is used by a lot of racketeers, lot of mafia guys, and pyramid is one such. Pyramids appeared in so many different forms. When one is tracked down, another appeared. It was gold pressed in one time. Mondial was the meme in one time. Then comes the solar panels. Okay, means what? Pyramid scheme is the only scheme where you pay first and get a job. Rest of the world, rest of all the institutions, what happened is first you work for 24 or maybe 30 days, and the end you get salary. Here comes a mechanism where the employee first pay and get enrolled. And a lot of people do that. Now that's another area we have to discuss. Okay, then how about your preparations? Last week or the previous one, when we were discussing about past papers, I could see some very good answers, and I'm really happy about that standard. Now it's up to you to get updated. Look at recent things. Okay. Now we came up with nice words like moratoriums, and last week the LTV was relaxed a little bit, right? So why? What is the impact? Think yourself, okay? Moratoriums, why they were introduced during COVID-19? What was the intention? All of a sudden, the LTV was a little bit relaxed last week. Why? What are the expectations? Now, that kind of thinking is required. So I showed you the questions are raised in such a manner, say insurance. 1, 2, 3 questions you can easily answer, and something comes out where you find it never tested. Okay, so that's how the questions are raised. In a given topic area, say about pawning, almost all the questions you already seen somewhere, but one thing new. Okay? To tackle that, please get updated by reading Financial Times or maybe listening to news. Please get updated. Okay. Right. So with that, I'll end today's session. Next week, we'll look into microfinance and corporate societies. Okay. Thank you.
So I have a question with regards to exam. When do we have the exams, sir?
Okay, next week I'll let you all this, and someone also asked me about obtaining past papers. Right, I'll give that answer next week.
Sure.
Okay, I'll do that.